Hey guys, I'm coming with the fourth part of our series, which is called investment strategies. Investment strategies for beginners is insanely important because what happens to an amateur investor is as soon as you start investing, there are associated costs which get added to your cost of purchase of the share. For example, if you purchase your stock for $100, there's an associated brokerage, there's an STT, security transaction tax, there's a GST. This accumulates over a period of time, especially if you're starting with a small corpus, the total percentage of brokerage and other charges becomes a little bit more. So now I'm going to give you guys simple examples which I have, followed, and I'm going to give you guys simple strategies which I followed, and this is really going to help you guys ensure that your investment strategies are on point, or it helps you guys get the cost of your purchase down, or it helps you in long-term investment. My first suggestion to you guys, or first strategy to you guys, is that you start with averaging. Now, everyone understands what averaging is. Averaging as a whole concept talks about that you can buy different prices and average it. Now, this is a beautiful concept which I realized much later. I bought this company called Intellect Design Arena. I bought this above $600. I bought about 100 shares. I invested a total of 60,000 rupees. The stock kept falling, but I was a long-term investor, so I kept holding on to it. The stock fell to below 150 rupees in over a period of 24 months. That was the time I averaged my position. I bought 400 shares now at $150 each. Now, all of a sudden, I've bought 100 shares at 500 plus each, and I've bought 400 shares at $150 each. Now I had a total of 500 shares, but my cost of purchase came significantly down. I sold the same shares this year for over $700. It helped me over a period of time to ensure that I could average my position. I could hedge my position, if I can call it that. And it also helped me make a lot of money in the same process. The whole idea is you use simple maths to ensure that you guys go ahead of the game. Now, what you need to understand is at what levels do you need to keep averaging. When a stock starts falling, you need to understand the reason why it's falling. It could be that it did not make as much money as it thought. It could be there's internal turmoil. It could be that the outlook of the industry is not doing very well. So there are several factors, but if you truly believe in the stock's power in long-term compounding and long-term growth, then you should average your position. Please do your own research before you use the averaging strategies, because there are several levels at which once the stock starts falling, you can buy at. So please keep purchasing small amounts, doing the same thing. There's a saying in the stock market that you cannot time the market. That means you never know whether the market's going to go up or down. So you need to understand that there is no right time to buy. Start today, and that's going to help you guys get ahead of the game. My second strategy for you guys is invest in the markets on a consistent basis. What that means is that if you can't time the market, if you don't know, if you're not an astute investor and you don't know when you will time the market or when you will buy or sell, you need to start buying small quantities of the same stock, mutual fund, bond, whatever the investment you're trying to do, and slowly build up your corpus in that. This means that if you start investing the very first time on the 1st of November, that means that in the month of November, you assume that you put $5,000. You can buy the stock, the company, the investment of your choice in November, but keep repeating that in November, December, Jan, Feb, March. So every time you're buying, you might buy it at different prices, which would again help you average the position. It could be you bought it at a higher price. It could be you bought it at a cheaper price. At the end of the day, your idea is that in a horizon of 12 to 36 months, the stock should be beating at least 10%. Now, why did I say 10%? 10% is very important to understand. We have an inflation rate, which is made of several factors. Inflation is basically the rate at which your money depreciates. The power of buying the same product today versus a year later will be different. most probably in a country like India, it will be lower. That means that if you buy 1 kilo of potatoes at $10, you might only be able to purchase lesser than 1 kilo over a year at the same $10. So what's going to happen is that if you don't make $10 through your investments, you need to be a little bit more cautious because you're losing money by investing in a company which isn't giving you exponential returns. Again, it takes between 12 to 36 months for a stock to give you its true power of investments. I'm going to give you the best example which we've seen in the last 12 months is a company called Reliance. Reliance Industries had not moved significantly in its stock price for over 5 years. And in the last 12 months, it moved exponentially and it made almost 3 times as money for its investors. So there's a time when there's a lot of development happening in the company. Reliance came up with Jio and many other factors were happening in the Reliance in the industries. But it came to fruition and companies flocked. They got the right kind of investors on board. They got global investors on board. They reduced their debt and investors were able to see a very good path for the company in the future. So one of the strategies which is proven really well for me in the short term is there are some stocks which I don't have the time to research as much as I'd like to. So what I've done is that if I see a movement happening in their price in the upward direction, I would buy quantities of that stock and I would sell it in a short period of time. And whatever profit would be left, I would buy that same stock. For example, I bought a company X at $100. I proceeded to buy 1,000 quantities of that share of that particular stock. In a month's time, that went to about $110. That gave me a 10% in a month's time. What I did with that particular 10% was, that gain was, I sold off my entire holding except for that $10,000 which I was able to make extra and keep that in the same stock. Now, my principal money came back and my profits were reinvested in the same stock, which I was not sure about. This is one of the best strategies I've used. I've used this in a company called Syngene, Syngene. I bought the IPO years ago for at $250. It went up to 500 rupees. I'd invested 15 grand. It went to 30,000 by over about 3 years. I removed my 15,000 rupees, which was my main principal. My principal is safe, but the other gains which I have, I still invested in that stock. And, now I don't have to worry about the stock, having a little bit up and down, because long term, if the company is going to do well, it will give you exponential returns. And, I'm not worried about losing any money per se. That's one of the strategies which I've used in a short term and in a long term. I've explained of what you can use immediately to begin your investments and create a portfolio in which your principal invested zero, but it's stock which is being created for you guys. It's equity which is being created for you guys in a wholesome sense, which will give you returns, hopefully, over a period of time. So I hope you've enjoyed watching the video on investment strategies. This is part 1 of the video. To know when part 2 comes, please click on the subscribe button. And I hope this is going to help you guys in the long run. Thank you, guys.